The world's going to come apart, and so is gold. Everything's going down at once, which, by the way, never happens historically. There's always some market, usually gold, that advances while everything else gets sold. And I still think silver's going, this year somewhere between $300 and $500 an ounce. I still hold with that. Ultimately, what drives gold, get an M2 chart. You want to know why gold goes up?
Gold reflects degradation of the fiat currency. Of course, that goes out of the headlines in a war.
It's a massive correction. Instead of looking at a daily chart of gold or silver, it's not really down. It's sharp up, sharp down, sharp up, sharp down. Whenever there's a down, we get the emotion. Like, oh, it's all over. If they don't, go right back up. All the bears will say, well, I got to get back in again. How do I do that?
You can be in a big bank and corrupt, and because you're part of the establishment, absolutely fine. So I think that's one aspect. They know where the stops are. They know when the pace of buying slows, and they therefore know when it's a good opportunity to just bang the price, take out a few stops, and in the process close some bears. Thank you very much.
Both metals selling off. Gold right now, where are we? Let me just check here. We're around 4,500. Silver at $70. Once again, why do you think this is? And if the conflict continues for the long term, how could that impact precious metals markets? Michael, I'll start with you.
War is always, people like to link war with gold. They interpret it as bullish for gold, which is nonsense. Okay, historically, you go back and look at it. The correlation isn't there, and now suddenly they reverse that. The world's going to come apart, and so is gold. Everything's going down at once, which, by the way, never happens historically. There's always some market, usually gold, that advances while everything else gets sold. So the notion that, gold's got to go down too because the stock market's going to go down and everything can go into margin calls, et cetera, it's hype. It's a news story that has no real lasting impact. Yes, it has some impact in that you've got tight supplies in oil right now, and I don't know how long that'll last, but that's not ultimately what drives gold, as Alasdair knows and I know, is continued monetary degradation.
The biggest myth investors cling to is that war automatically drives gold higher, and that assumption quietly breaks portfolios. As Michael Oliver points out here, the historical correlation between war and gold strength simply doesn't hold, yet media narratives keep pushing that linkage as if it's law. What's actually happening is a liquidity squeeze dynamic. When margin calls spike, even safe havens get sold temporarily, something we saw in March 2020 as well. The deeper driver remains currency debasement, not headlines about conflict or oil supply shocks. Next, Michael Oliver discusses why money supply expansion matters far more than any geopolitical storyline.
It's get an M2 chart. You want to know why gold goes up? Take a look at it, okay? And then look at an S&P chart during let's say go back to 2000 when the stock market made a .com peak, and look at an M2. Measure how much it went up. You know how much the S&P went up? Same amount. Yeah. Didn't do any better owning the S&P than just. It merely reflected the degradation in the buying power of the U.S. dollar, the number of units. Gold vastly outpaced that all during that time. Yes, there were ups and downs, and some people like to link up with a moment here or a moment there, like October of 2008, when a full year after the stock market had been going down, it finally had a puke month. And gold said, hey, I've had a heck of an advance. I think I'll have a corrective month. And so it had a bloody October 2008. Then they separated again, and gold continued up for another 3-4 years, and the S&P continued down and didn't even get back to its high until 2013, whereas gold had already, doubled from there. So anyway, those kind of news stories are interruption moments. They're not really the major reason, the rationale underlying what's going on in gold and silver.
Most investors think stocks create wealth, but they often just mirror currency dilution over time. As Michael Oliver points out here, from 2000 to roughly 2013, the S&P 500's gains largely tracked M2 money supply growth, meaning real returns were far weaker than headline numbers suggest. Meanwhile, gold didn't just keep pace, it outperformed significantly, especially after the 2008 liquidity shock when it doubled before equities even recovered. This exposes a critical blind spot. Nominal gains can hide purchasing power loss, especially during aggressive monetary expansion cycles. Next, Michael Oliver unravels why short-term crashes distract from long-term monetary trends, driving metals higher.
And Alasdair, would you tend to agree with that this is perhaps more noise than signal and people should be more focused on the underlying fundamentals of the metals as opposed to, expecting that they're going to skyrocket due to geopolitical uncertainty?
Yeah, no, I would agree with that. I mean, it's, as Michael says, basically it's gold reflects the degradation of the fiat currency. And of course, that goes out of the headlines in a war. The other thing I would say is that the world of investors and investment managers are all Keynesian driven, macroeconomists, if I can get the word out. The problem with that is that macroeconomics is a non-science. It was invented by Keynes from his general theory, but everybody believes in it. Now, the result is that they've lost the lodestar that gold really is. And I think the other thing is that investors tend to look back a little bit, within their own experience and say, well, what happened under these circumstances before, when we had a crisis? And I suspect that they're looking back towards that 2008, 2009 financial crisis.
Investors often mistake complex models for truth when they may just be reinforcing flawed assumptions. As Michael Oliver points out here, gold's real signal comes from currency degradation, yet most portfolio managers remain locked into Keynesian frameworks that prioritize growth narratives over monetary reality. This creates a dangerous bias, looking backward to 2008-style crises instead of recognizing structural shifts in debt, liquidity, and policy responses today. The result is missed positioning, especially when markets behave differently than past playbooks suggest. For long-term investors, the gap between theory and reality can quietly erode returns. Next, Michael Oliver talks about how past crisis reactions still shape today's misinterpretations.
Because gold fell from around about $1,000 down to $680 quite rapidly, and then after that it tripled. It tripled between I think about January, February 2009 and September 2011. In other words, there was a sort of an initial reaction, and I suppose you could justify it by saying that, if you suddenly think, my God, well, there's so much risk around, I need to take account of that risk, then you go into the dollar. You sell currencies into the dollar because the dollar is big, liquid, it's easy. It's something you don't have to discuss with your compliance officer, if you like. So this is it's the easy way out to deal with this situation. And if you're going to explain it to the customers, the clients who you manage money for, they can understand that. They don't necessarily understand gold.
I just want to follow up quickly and ask about the day that silver dropped 26% in a single trading day. There's also people calling foul in that event, saying there were supposed to be circuit breakers triggered on the COMEX when the metal moves up or down by a certain percentage within a certain amount of hours.
What looks like panic selling is often just a temporary rush into liquidity, not a collapse in fundamentals. As Michael Oliver points out here, during the 2008 crisis, gold initially dropped nearly 30% before tripling by 2011, showing how short-term fear-driven moves can mislead investors. The dollar becomes the default safe asset simply because it's liquid and institutionally accepted, not because it preserves value better over time. Events like a 26% one-day silver drop raise valid questions about market structure, but they also expose how fragile sentiment can be in leveraged environments. Next, Michael Oliver discusses whether these sharp moves signal manipulation or just market mechanics.
There's a bit of debate about this online. Is this another event that you're not paying attention to as well?
That event was interesting, and it does cause doubt or suspicion. But since I can't do any more than have doubt or suspicion about why it occurred, what do I do about it? Yes, it was a massive correction, but since then, and I just sent you some charts, I mean, if you really stand back and instead of looking at a daily chart of gold or silver, You just go to your quote screen and punch up a monthly continuation chart of gold futures or silver futures since late December, early January. It's this. It's not really down. It's sharp up, sharp downs, sharp up, sharp downs, redundant territory. And so whenever there's a down, we get the emotion, like, oh, it's all over. And when it goes back up, everybody sort of gets quiet and a little bit happier. Uh, it's been months, a couple of months of this now, constant down, but they don't seem to keep going. Okay. Maybe we found our new reality up here for the next launch, for the next phase.
Short-term volatility often tricks investors into seeing trends that simply aren't there. As Michael Oliver points out here, when you zoom out to a monthly chart since early 2026, gold and silver aren't collapsing. They're chopping sideways in a high volatility range. This kind of price action typically reflects consolidation after strong moves, not a breakdown, yet retail sentiment swings wildly with each drop. It raises a key question. Are investors reacting to structure or just emotion, amplified by daily charts? For disciplined portfolios, this is where positioning matters more than prediction. Next, Michael Oliver discusses why this volatile range could be setting up the next major move.
And I still think silver's going, this year sometime, somewhere between $300 and $500 an ounce. I still hold with that. I don't have any macro technical reasons based on our methodology, momentum-based structure, to assume otherwise. This is not 2011 top. We call that top 2 months after the high and said, that's it, it's over. Okay. Same at the bottom in 2015. There was massive clear momentum trend structure, not just looking at a price chart. Price chart didn't really give you a big clue. But right now, everybody's looking at price thinking that's it. No, it's a congestion zone. Yes, it's violent. Why not? The market trend itself has become far more vertical and violent. So therefore, the congestion zone is not going to be pipsqueak quiet. It's going to be violent as well. So don't fear every drop. And frankly, we've got a very short-term analysis, which I sent you today. Today's drop, the bears better keep it going like right now, today, tomorrow, the next day.
Extreme price targets grab attention, but the real signal lies in how trends behave beneath the surface. As Michael Oliver points out here, current momentum structures don't resemble the 2011 peak or the 2015 bottom, suggesting this is a mid-cycle consolidation rather than an end. What most investors miss is that more vertical trends naturally create more violent consolidations. This isn't instability, it's structural intensity. The danger is reacting emotionally to sharp drops instead of recognizing them as part of a broader trend framework. For long-term holders, discipline during chaos often defines outcomes. Next, Michael Oliver talks about the critical short-term battle that could decide the next directional move.
If they don't, going right back up. In which case, all the bears will say, well, I got to get back in again. How do I do that? And they won't get back in better than where they got out, I'll tell you that. So, anyway, that's our assessment of that.
And Alasdair, your thoughts on the glitches and perhaps just a wider narrative out there about manipulation of the precious metals, because sometimes it gets to be a little hyperbolic to the point where people call every downturn in gold or silver the banking cartel smashing the price. Here we go again. They're manipulating the market through paper contracts on the futures. And, eventually they'll fail, but there's an existential struggle between sound money advocates and the evil banking cartel, and it's coming to a head. What is your thoughts on all of that and the glitches we've discussed?
Well, so what? Basically. I mean, there are two underlying points, I think, in this.
Markets don't punish you for being wrong. They punish you for reacting too late. As Michael Oliver points out here, if prices snap back quickly, bearish traders often get trapped and forced to re-enter at worse levels, a classic squeeze dynamic seen repeatedly in volatile cycles. This creates a feedback loop where emotional exits turn into forced buying, amplifying moves in both directions. The louder narrative about manipulation often distracts from this structural reality of positioning and liquidity. Investors need to ask whether they're analyzing the market or just reacting to it. Next, Michael Oliver discusses the deeper mechanics behind perceived manipulation and market behavior.
First is, what is the COMEX actually doing? I mean, we know from the Hunt brothers that they're not above changing the rules, when things sort of cut up kind of rough. So, what's new in that? I know also from my interaction with regulators when I was a broker and a banker that they actually treat the smaller guys a lot more viciously than they do the big boys. So big banks actually can get away with quite a lot. As was shown, you had a JP Morgan dealer who was on the board of the LBMA who ended up in jail. I think he ended up in jail. Either he did or his... So in other words, you can be in a big bank and corrupt, and because you're part of the establishment, absolutely fine. So I think that's one aspect. The other aspect is that, when it comes to market making, which is essentially what these guys are doing, then they don't need necessarily to work together in the same direction, because they can suss out exactly how the market feels. It's their business, and they're the right side of the quote the whole time. And they know when it might be a good moment to just bang the price and shake the trees and close a few bear positions. It might create the impression that they're working in concert, but actually, if you're on the short side and a few other guys are on the short side, you tend to be getting the same signals. So you don't actually have to go and sort of get on the phone and say, I think this is the moment when we've got to bang the market. The answer to that basically is that people who complain about the behavior of market makers, first of all, they can't really establish anything. And B, the lesson in that is that if you're playing in the market, they're far bigger players than you.
The system isn't necessarily rigged in plain sight. It's structured in a way that quietly favors scale and access. As Michael Oliver points out here, large institutions don't need explicit collusion to dominate outcomes. They operate with better information, faster execution, and deeper insight into market sentiment. History, from the Hunt brothers to more recent enforcement cases, shows rules can shift when pressure builds, but the bigger reality is structural advantage, not constant conspiracy. Retail traders often misread coordinated behavior when it's actually shared signals among dominant players. Understanding that difference is critical for survival. Next, Michael Oliver unravels how traders should navigate markets where size and positioning dictate outcomes.
And you're going to, and this is why most traders actually lose money. By number, most traders, if you like, small traders, they go in and they think, it's time to buy gold or it's time to sell this or whatever. And they inevitably get it wrong, partly because they're probably headline driven rather than anything else, but mainly because they're part of a herd. You think you're independent in terms of your view, but you're not necessarily. There are other people doing exactly the same thing, and the market makers can suss it out. So my view on this is, so what? You've got to understand really what's happening and deal on that basis, rather than sort of complain when things don't go quite your way. The system is what it is. It's, it may be full of cheats and fraudulent behavior and all the rest of it, but you've got to accept it if that's the case. But very often, dealers basically, they know where the stops are. They know when the pace of buying slows, and they therefore know when it's a good opportunity to just bang the price, take out a few stops, and in the process close some bears. Thank you very much.
The uncomfortable truth is, most traders don't lose because markets are unfair. They lose because they think like everyone else. As Michael Oliver points out here, herd behavior combined with headline-driven decisions creates predictable patterns that larger players can exploit with precision. What's rarely said is that stop-loss clustering becomes a target, not protection, especially in leveraged environments where liquidity hunts are routine. This isn't just theory. Data consistently shows retail traders underperform due to timing errors, not bad assets. For investors, understanding positioning matters more than predicting direction. Next, Michael Oliver unravels how this dynamic ties into broader commodity mispricing.
The value of commodities. If you look at them in real terms, and by that I mean pricing them in gold, because we know that gold over long periods of time retains its purchasing power. Therefore, if you look at commodity values priced in gold, you're going to see whether they're relatively cheap or relatively expensive. Virtually everything that I've looked at in terms of where it should be, and I'm talking about the long-term value of a basket of commodities, for example, base metals, or even oil, energy as a whole, they're both standing at roughly a quarter of where they should be priced in gold. Now, I'm not saying that, that a return to sort of unity, as it were, makes is a dead cert. But what I am saying is that priced in gold, the consequence of fiat currencies has led to these commodities being very, very underpriced. And to return to normal, even in gold, these commodities should rise by roughly 300%. So you can see that, and if you put a debasement trade on top of that, you can see that, my goodness, these are going a lot higher. So I agree with what Michael was saying about oil, for example, being in a long-term bull market. I think that any pullback, we have seen these pullbacks. Oil very often disappoints this way. But if you look at what's actually going on with Iran, it is clear that Iran is not going to stop this war. If Trump just decides to taco, don't expect the Iranians to go with it. They want to get rid of Satan. They call the Americans Satan. They want Satan out of the Gulf. And that basically means that they will continue to bomb anyone who allies themselves with Satan.
Valuations look normal until you measure them against something that doesn't lose value. As Michael Oliver points out here, pricing commodities in gold reveals they may be sitting at just 25% of their historical relative value, implying a potential 300% reversion even before accounting for further currency debasement. This reframes the narrative completely. What looks like a commodity rally could actually be a currency collapse in disguise. Investors focusing only on nominal prices risk missing this structural shift, especially as energy and metals remain tied to geopolitical supply constraints. Next, Michael Oliver discusses how this imbalance feeds into long-term inflationary pressures.
And also, the future of Israel is very, that's up in the air now. It really is. These guys basically have taken out the interceptors. They haven't started really, they've done a few, but they're just starting to launch their hypersonic missiles, and nothing can stop them at all. The destruction we're about to see coming out of Iran is major. The idea that there can be regime change, the idea that the population will turn, you can forget it, because the population are not going to turn against a government. They have seen what happens to Iraq. I think all you do when it comes to oil, energy, and all the rest of it, and commodities, basically you've got to take the view that this is, it's not so much a bull market in them, though it is because they are undervalued in gold, but also it's a massive bear market in fiat currencies.
Geopolitical narratives often sound extreme, but markets only care about what they do to supply and pricing power. As Michael Oliver points out here, the real takeaway isn't just conflict escalation. It's the implication for energy markets and, by extension, inflation cycles. When supply risks rise, commodities gain pricing power, and that feeds directly into currency weakness, especially in highly indebted economies. What's rarely acknowledged is how quickly this can shift investor positioning from growth assets into hard assets. For portfolios, ignoring these second-order effects can be costly. Next, Michael Oliver unravels how this ties into the broader collapse risk for fiat systems.
Just imagine at the end of this year, 2026, imagine what happens if we see bond yields over 15%, for example, inflation at 25%. I can't rule it out. That's really what we face. We face also the collapse of the fiat currency system. which China has insulated itself against, incidentally. So, and when you get a collapse of a fiat currency system, there are only two outcomes, basically. The first is that the political class see the danger and can take the electorate along with it in order to cut public spending, run budget surpluses, reduce government involvement in industry, like cutting regulations and all the rest of it, or the currency dies completely. Now, on the latter course, I think we've probably got no more than a couple of years left because of this huge mistake made over Iran.
Extreme scenarios sound unlikely until policy constraints make them unavoidable. As Michael Oliver points out here, the idea of 15% bond yields and 25% inflation may seem distant, but history shows that once confidence in fiat erodes, moves can accelerate rapidly. The real issue isn't just inflation, it's the political feasibility of austerity, which most governments avoid, leaving currency debasement as the default path. Investors often underestimate how quickly bond markets can reprice risk, especially during debt stress cycles. For long-term planning, this isn't about panic, it's about preparation.